Hello and welcome to the Fat Tailed Thoughts podcast, where we discuss the mechanics and workings of finance, money, and cryptocurrencies. My name's Stephen Dickens. I'm your co-host, and I'm joined as always by my dear friend and fellow co-host, Jared Klee. Welcome to the show, Jared.
Good morning, Stephen. How are you?
Yeah, very good, very good. We're a little bit late recording this, but I think we'll manage to sneak it out. This is the episode we're recording after the Thanksgiving break here in the US. So our schedule is a little bit sort of moved around. So we've decided this week to go back and cover a topic that Jared wrote the newsletter on a few weeks ago, which is the size and relative growth rates of the cryptocurrency space. Fantastic topic, really timely. So Jared, get us orientated.
Well, Stephen, we could cover the Thanksgiving letter, which was 1600s era health remedies.
I think we'll skip that. I highly recommend you go and read it. It's a fantastic take on the current climate and everything that's going on, but I think we'd better steer clear of that one.
All right. We'll stick with the size of the cryptocurrency market then.
I think so. No, listeners, all joking aside, fantastic newsletter. Very witty take on some of the health things you should be thinking about and comparing back to a few centuries ago. But
it's quite a lot of fun, and as you might expect, most of those are not recommended. But I did manage to dig up. Just for folks that want to go look for it, I did manage to dig up a remedy to what we'll call the Nicki Minaj's cousin's, we'll call it situation. And if you're not familiar, it hit social media maybe 3 months ago anyhow, feel free to look that one up.
Moving swiftly on.
It involves parts that we won't talk about, rather uncomfortable for the men. But anyhow.
Yes. Highly recommend the newsletter. So, as I say, let's dive straight in here. The relative growth and scale of the cryptocurrency market compared to, I think you picked some really fantastic things to compare it against: oil, gold, and stocks. Let's just frame up the initial discussion here. What are we going to do in this podcast? What are we going to cover? Just let's get the listener orientated.
Of course. So, Stephen, if you spend 5 minutes in the cryptocurrency world, you will run into what we'll call a Bitcoin maximalist, a quote unquote true believer here. And you'll see folks like Pomp, who runs a wonderful podcast, but regularly tweets and flaunts quotes like Bitcoin is the fastest growing financial product in history. And despite lots and lots and lots of quotes, lots of folks saying it, I've never actually seen data that bothered to analyze the fact. And to me, it seemed a bit cultish of, well, if we say it enough and we say it loudly enough, therefore it's true. And yet we have products, big products, gold, oil, stocks, where we have pretty robust history. Now, I just focused here on the U.S. because I wanted to benchmark this against GDP. It's not fair to compare something that when the country was a fraction the size it was now, or if we go back to antiquity and it gets much more complicated. So just taking really the U.S. since about 1800 and saying, okay, let's benchmark how big is this thing or these things against the size of the country at that time. And from the 1800s forward, we have pretty robust data. Certainly good enough for the purposes we're going order of magnitude level comparisons. Where we're going to get to, and Stephen, I'm going to jump all the way to punchline, Bitcoin really is in a class of its own. Mm-hmm. If you look at it from a growth rate perspective, it's quite literally off the charts. And then if you look at it from a percentage of GDP standpoint, it's not quite in a class of its own, but it remains remarkable compared to almost any other asset class you can imagine.
And we're talking directionally. And we're talking directionally here. We're not sort of getting in on the price and the market cap of the asset this morning. You're talking directionally over the decade plus we've had Bitcoin, comparing that to sort of growth of three big sort of asset classes or things we can track with some measure, and looking at that growth. So we're not, just for the listeners, if you go back, we'll put the link to the newsletter in the show notes. We're not making price statements of whether it's 58 or 63K, or it's directional statements we're making.
Correct, Stephen. And for the historicals, there's good data on average price in the year, and especially if you take it over a 200-year time point, kind of taking end of year or whatnot, you'll get reasonable curves. Cryptocurrency, given that the time scale is so much shorter and it's a relatively immature asset, certainly compared to something like gold that's been around for quite some time. So I took average beginning, middle, end of year, basically end of first quarter, etc., so that you get some type of average across the year. I tested it doing beginning of year, end of year prices, etc. It doesn't make it is so far down the spectrum of being ridiculous from a growth standpoint, being ridiculous as a percentage of GDP standpoint, that those types of adjustments don't really make a difference in the conclusion anyways.
So now you've taken us all the way to the end. We've managed to condense the podcast into 6 minutes and 24 seconds, which is unusual if you've listened to the first few episodes. So let's indulge ourselves. Let's make it a full half an hour. Let's go right back to the beginning. Yeah. The first thing you compare it to and dive into is oil. Let's talk about oil, sort of going back to the 1800s and that as a growth, because I think that was fascinating for me. I hadn't done that analysis, and I don't think many of our listeners will have done. So take us there first and dive us into that market and how fast that grew.
So even before oil, Stephen, the reason I started with oil was I looked at starting with users and user adoption. And from that perspective, and really from that perspective only, cryptocurrency is pretty unimpressive. Gemini a few months ago estimated about 21 or so million people, about 14% of the US owns cryptocurrency. Now we've seen other estimates of size, etc. That's 12 years after the launch of Bitcoin. Just for listeners' perspective, in 1993, Mark Andreessen launched Netscape, went public, etc. It had over 1 million users in the first year. It peaked at close to 50 million users. TikTok today has over 1 billion users. 1 billion. And it's not even 5 years old. I mean, it's half the age, less than half the age of crypto. So what we're going to find is a concentration here of, despite crypto being quite large, it's unusual in the story we're going to tell if it's concentrated in a much smaller portion of the population.
So you're picking market capitalization, value of the asset, rather than users of the asset as the growth measure. I think that's a useful distinction to get out of the way. I think I heard a statistic over the weekend. 0.1 Bitcoin or more is owned by 9 million people. Yeah. So that surprised me that it was so low. I'm interested to know the amount of people who own 1 Bitcoin or greater. I'm trying to find that stat.
It falls off quite quickly. Mm-hmm. There is real concentration there. But back to oil. Oil. But oil's a fascinating story because it's we think of Texas today. We think of the Middle East, for instance. You actually have to back up, and it's a wonderful story. And for folks that really want to dig into this, I'd highly recommend a book called The Quest. It's quite literally a history of oil. It looks at it from a production standpoint as well as from a geopolitical standpoint. It's really effectively a biography of oil. I will warn folks, it's an 850-page book. So this is...
It's not like bedtime reading then, is that what
you're saying? Oh, it will put you to sleep, though.
Okay.
It's a brilliant book. But the history of oil starts 1859 in Pennsylvania. We think of Rockefeller, which gave rise to Standard Oil, that if it eventually gets smashed apart in antitrust movements. But that almost any oil company you can think of in the U.S. today can date back to your Exxon, your Mobil, which eventually merged, so on and so forth. Those at one go back 100 years. That was Standard Oil. At one point controlled over 90% of oil production in the country. A bit unusually here, Standard Oil wasn't actually producing the oil. They were a middleman. So they would take the raw product and they would convert it first into kerosene. So for lamps and whatnot, great alternative to whale oil. Later, as the car comes along, it becomes gasoline and so on. You have the refined oil products. But I highlight that because you can imagine that kerosene, while a phenomenal alternative for lamps, didn't drive the same demand that gasoline did. We would see shortly thereafter. By the time we have the car coming along and that type of demand, Texas is now on the scene. The Dakotas are now on the scene. Wyoming is now on the scene. You've got other states where we get these massive geysers. Texas is probably the most fun of those. Texas shows up in 1901. It was basically a complete guess, and it's a wonderful tale of what you would call your wildcat oil prospectors. It launches at Spindletop Oil Field, and it's called the Lucas Gusher. And the story as it goes, when they eventually tapped the underground well, the oil shot 50 feet in the air. It sent multi-100-pound steel pilings and pipes flying hundreds of yards away. I mean, it was basically you got people journaling. There was slow rumble, and all of a sudden an explosion that was heard in the next couple towns away. I mean, it's a wild, wild story, and perfectly.
Only in Texas, right?
Exactly.
Texas. They have to come in big, they have to come in strong, and they have to sort of blow everybody away.
That's exactly right. So what we find is that oil goes through this curve, and we kind of get this long from 1859 through the beginning of the car era. It's it's a slow but steady rise from kind of under 1% of GDP, slowly working its way up to 1% of GDP. As then we get the car, and critically here, Stephen, we get World War I and World War II, which you can imagine we discover quite quickly that the ability to move troops around is tremendously important as the theater of war expands beyond Europe into the north of Africa. Oil becomes a massive, massive driver. Access to oil becomes a massive, massive driver of a lot of the dynamics that happen on a global scale. If you dive into how Japan moves out of its country and expands, again, a major drive. There functionally is no oil in Japan. So World War II, their ability to wage war is highly dependent on going and exploiting the South Pacific, and specifically Indonesia and the like, to go get access to oil. So what we see is this spike during World War II, both because GDP falls and because oil production rises up to about 1.5–2% of GDP. Oil annual production as a percent of GDP. It then falls off in the wake of World War II. Simply GDP is booming. We're using more oil, but GDP is growing faster. And frankly, we're discovering more oil, but it's staying. We have price caps and the like. Then the 70s hit, and for folks that are around in the 70s, if you remember the gas lines and so on, the price of oil went through the roof. This is when you have the standoff in the Middle East, development, really OPEC coming into its own for the first time. That's kind of the high point.
So if that's the high point, what was that as the maximum percentage of GDP? 3%.
3%. So that it's this rapid spike, Stephen. This is not a sustained plateau at 3%. This is a rapid spike, and then it falls off, and it's now leveled off closer to 1.5%.
So to summarize then, from the sort of 1900 sort of through to today, maximum 3% in the 70s. Yeah. This is the relative size of the oil kind of market. Obviously, GDP's moving, right, oil's moving, but the relative compare, maximum 3%. peaks at 1.5%, back down today at 1%. Is that the kind of short summary?
That's the short summary. An important highlight there, Stephen, oil is consumed. So unlike gold, unlike stocks, unlike cryptocurrency, we're not eating this, we're not burning it, it's not fueling our houses and our cars. So the appropriate comparison for oil is annual production. What's going to change as we talk about the next three asset classes is gold, once it's mined and produced bars, jewelry, etc., it sticks around. So we're going to end up comparing to the total value of the outstanding gold as opposed to annual production.
So I think that's a great segue. Let's go to gold next. So the first market you analyzed was oil. The second market you analyzed was gold. I think some direct correlation here. A lot of people call Bitcoin digital gold. You know, the Peter Schiff, Pomp kind of debate between those two is fascinating. So talk us through kind of, obviously gold, probably a lot longer history as a medium of exchange and a store of value, but talk us through the analysis you did here.
So I stuck to the US. For folks that are interested, I'd be happy to share if anyone wants to reach out. Britain has publicly posted prices of gold dating back to 1257.
See, you guys think you've got history over here, but, you know, we've got proper history, right? Moving on. I don't want to derail us, but yes, we've got proper history in the UK.
Stephen, I was talking to the colleague telling me the home I live in dates back to the late 1800s. And he just started, I said it was an old home dating back, and he started laughing. His house dates back to, I believe, the 1400s, 1500s. And as you walk through his home, he did this on a video chat with me. As you walk through his home, you've got the different parts of the home, and you can see just by the fireplaces what era it was built in. And you can see the addition, the quote unquote new addition from the Victorian era. It was like, wild.
Yeah. Proper history.
Proper history.
Yeah.
So again, stuck to the US. We think about the California gold rush. Gold's found in 48. We had the 49 gold rush. We actually had some minor gold rushes prior to that. Georgia, 1829, Alabama, 1830. These are much smaller in nature, and California blows the whole thing out of the water. But important to point out that actually it's not the first gold. It's just the first big gold that we find in the country. Alaska comes later, of course. What gets interesting in the story of gold is total production versus production as a percentage of GDP. Total production, we are actually early 2000s. It's since fallen off. We're producing way more gold in this country than we ever have before. In the early 2000s, we were producing about three times as much gold per year, mining three times as much per year as we were in the era of the California gold rush. What's changed is that GDP has grown enormously. So when the California gold rush, we see this kind of slow but steady total value of gold somewhere on the order of 2% of GDP. Again, remember, oil's consumed. This gold is cumulative because it sticks around. But we see gold basically staying level with GDP around 2%. All of a sudden, the gold rush happens. It spikes, and it spikes massively in just a short handful of years, up to about 16% of GDP, just shy. I just want to point out here for folks that are thinking back, imagine waking up one day and finding out that your currency that's based on gold, there are 9 times as much gold in the economy as there was before. What that means is that you've effectively created 9 times as much money. You can imagine the inflation that comes along with this. This is one of the big drivers for why we don't use a gold standard anymore, which is, yes, on average over long periods of time, gold production is steady. But the idea of your money supply being influenced by somebody going and discovering a bunch of shiny rocks out in a new part of the country is not a particularly effective way of trying to run the country.
And what we're doing now by printing 40% of the money supplied that's in circulation in the last 2 years is a better option. I think
we can have that discussion, but we know one of them didn't work out well, and we're trying a new one.
Yeah, we're running an experiment in real time to see whether we can break the fiat system, because we broke the gold standard system. So now we're trying to break the fiat system.
Why not?
But I think that's the subject of a whole different podcast. So where are we? So you talked about the gold rush. You talked about that peak at 16. Where are we now? Where does gold sort of track in, let's say, modern times? Let's say the last sort of 20, 30, 40 years, maybe.
Sure. So we see a sustained a sustained amount, rather a sustained 16%-ish, 15-16% of GDP for about 20 years on the back of that gold rush. I mean, more comes out. It's simply just in slower increments. We see a spike then leading up to World War II. Again, most of that is driven in this case by GDP crashing as opposed to novel gold. There is new gold production, but it's mostly driven by GDP crashing. Excuse me. And it then is kind of on a slow, steady decline with some peaks here as we find new gold, etc. But we've now leveled off somewhere just shy of 4%. Of GDP. That looks to continue to fall year over year over year. We peak gold production in the U.S. all time happened in the early 2000s. We're still producing a phenomenal amount of gold in this country, but it's falling quite rapidly as a percent of GDP. So
and that's because GDP is increasing, correct, not because gold production's.
Well, correct, but also as GDP gets bigger, in order for gold to try and quote unquote keep pace as a percent of GDP, we would have to produce, if we have GDP increases of 2% a year, we'd have to have gold production increases of GDP of 2% a year just to keep pace. And we simply don't have that. In fact, we're falling gold production, so it gets hit twice. So we've leveled off somewhere on the order of 3 or 4%, Stephen, but unless something quite novel happens, expect that to continue to fall.
Okay. So I think peaks at 16%, California gold rush, back down to sort of 3-4% as where we are as percentage of GDP.
So I'd highlight two things in that story. Yes, spot on. I'd highlight two pieces of that. As a year-over-year change, just to give folks a sense of the magnitude here, going into the years of the California gold rush, 49, etc., 1849, the year-over-year change, gold increases as a percent of GDP by about 80%. I mean, It's this massive jump. Oddly enough, we see that again in the early 80s. That peak, that small peak, is dual though. One, we do have a smaller but meaningful increase in gold production. We also have a massive GDP crash. This is late 70s, early 80s. So that we actually get up to 80% increase as a value of GDP again, but it's a different story that time. It's more driven by the GDP fall than it is by the gold production increase. But I want folks to keep that number in the back of the head. We peak at 16% of GDP value, gold value as a percent of GDP, 16%, year-over-year change, 80%.
Okay. So the final category you looked at was stocks. Obviously, lots going on in that marketplace, particularly in the last sort of 20, maybe 30 years. Give us the view there. We've obviously got some good data from the New York Stock Exchange, particularly, that you mentioned in the newsletter. Just give us that view, the sort of 3-4 minute view there, if you would.
Sure. It's a stock market has changed remarkably, both in terms of its makeup as well as its role in the American public. If we go back to the era, the 1920s, as we hear all these wild stories about the stock market then and leading up to the crash of 29 and so on. What's fascinating, Stephen, only about 5% of the country actually owned stocks. So while it's this wild story, it's pretty much isolated to New York, Philadelphia, a couple of the major cities. The vast majority of the country simply is not exposed to this. This is an era prior to 401ks. This is an era prior to IRAs and the like. Most folks had, if they had a retirement savings, it'd come in the form of a pension, which paid out cash. So what we see as a result is the stock market all the way through the 90s even plays a relatively small role. Now it's large simply because it represents public companies, but as we think about it today, it's much, much, much smaller. So leading up to the crash of 29, the stock market peaks just shy of 100% of GDP, meaning the total capitalization of all public companies, quote unquote, the value of the stock market, if you want to think about it that way, peaks just shy of 100% of GDP. It fails to reach that level again as a percent of GDP till 1995, really in the beginning of the 90s dot-com era boom. From then on forward, we basically, with the exception of the crash of 2008 for about 5 minutes, we basically never fall beneath 100% of GDP again. We peak at the end of the, we hit a series of peaks as we kind of in the modern era follow the stock market booms and crashes. You can imagine as we hit the end of the dot-com, we peak just shy right around 150% of GDP and then crashes back down. Then in the early aughts leading up to 2008, we peak again just shy of that 150 mark, crashes again in 2008. We've since been basically on a bull market since the end of 08 with a couple of hiccups. We're now somewhere north of 180%, 180% of GDP. Total market cap somewhere north of $25 trillion. So it's been a really interesting story. You've got this history of the stock market from like 1900 to 1995, called 100 years or so of history, where we're floating south of 100% of GDP. And for most of that time, closer to like 60, 70, 80%. And then post.com, you've got this kind of floor somewhere at 100% of GDP or higher. And in certainly the last 10 years, we've continued to tick higher and higher and higher, now close to double that.
And where we're going with this is, and I think that's fantastic comparison, looking at those particular histories, looking at oil, looking at gold, looking just most recently there in the conversation around stocks. You went on this passage of discovery to compare these assets and these commodities to where crypto is. So let's spend the last few minutes there. You know, oil, 1.5% of GDP, gold, 3 to 4% of GDP, stocks, you know, now at north of 150, more accurately about 180% of GDP. What was your analysis of crypto and particularly Bitcoin? Obviously a lot shorter time history. We're talking 2008, 2009, probably, from when we've got first real price comparison data. But talk us through your analysis there.
So I want to summarize the rate of growth as well, because that's the other place where we'll find crypto gets frankly ridiculous. So just hitting on that growth. So we've got that, Stephen, as you said, that about for oil, we've got that peak at around 3% of GDP. For gold, we have that peak around 16% of GDP. For stocks, modern era, we're peaking and still going up close to 180. But in terms of growth, year-over-year change as a percent of GDP, oil, right when it comes out, because it kind of quite literally comes flying out of the ground, peaks at about 125% year-over-year growth as a percent of GDP, and then is basically, it doesn't really get above 50 thereafter. Gold, with that massive gold rush at 1848, 1849 California, peaks at 80% growth year over year. Stocks, because it's always been relatively high, it never really gets much above 50. 50% year-over-year change. And it's frankly far more steady than the others. Crypto gets rather interesting, Stephen. Gets rather interesting very, very quickly. To summarize, and crypto basically doesn't matter, and it's a rounding error in terms of percent of GDP, in terms of total market cap through about 2017 or so. If folks remember, as we get that massive kind of the first wave of crypto boom, Bitcoin gets up to right around 20,000 in 2018, and then it crashes. We have the kind of first major crypto winter in the public eye through 2019 and through 2020. At its peak in 2018, we're just north of 1% of GDP, about 1.25%.
Mm-hmm.
Now we're going to come back to the growth, because the growth here is pretty astonishing. As we crash back down, it falls down closer to 1%. In the subsequent 2 years, basically up through present, we are now, Stephen, north of 7% of GDP.
So we're talking about an asset class that can probably trace 12, maybe 13 years max of growth, and we're already at 7% of GDP.
Yeah.
That to me, and I read the newsletter again today. I read it previously, and I've read it again today. That frankly astounds me of how fast we've got there.
Stephen, to be very clear, I wrote this letter with the full intent of disproving all the shenanigans I saw all over Twitter, all the crypto maximalists going. There's absolutely no, every time I hear this time is different, this thing's unique, and you hear, if you spend enough time in the finance world, you hear that story again and again and again. I went, politely, this is bullshit. I'm going to go write a letter, grab the data, and prove it wrong. And I got to this point, and it was one of those jaw on the table moments for me. The growth rate, the percent, I mean, it was wild, Stephen, absolutely wild.
So Pomp was right. This is the fastest growing asset class that you'd looked at?
So of anything I looked at, absolutely. Now, I want to highlight, because somebody I'm sure in the comments and listening will go do this. Yes, I guarantee you can go find some teeny little nothing asset class as we talk about growth in a second that has a faster growth rate as a percent of GDP. Good luck finding one that does
baseball cards is one that instantly comes to mind.
Correct, but good luck going and doing it and finding one that's also a meaningful percentage of GDP.
Mm-hmm.
I look forward, by the way, to being proven wrong, but you rapidly run out of asset classes that's actually large. So let's talk about growth here, Stephen, because it's a wild story. So I'm going to completely ignore the early ages of growth, because it's yes, in the 2010, 2011, 2012, when the crypto market cap is like $50 million, $50 billion, it shows up as 5,000% growth as a percent of GDP. Reason being is it's going from 50 billion to 75 billion to 100 billion. It's not a meaningful measure. Jump forward to that 2017, 2018, that when we finally see that boom, all of a sudden we're on the radar at 1% of GDP. That's all of a sudden something slightly more meaningful. Stephen, as a percent of GDP, 2016 into 2017, we see a 900% year-over-year growth. I just want, again, going back to the numbers, we saw oil, like the oil early days when it first comes out, peak at about 120. We see gold in the gold rush peak year-over-year growth at 80%. We see the stock market, even when it's going bananas, peak at about 60%. 900% year-over-year growth. And what's wild, Stephen, this is when it's peaking at this 900%, it's bigger as a percent of GDP than oil was at its peak, than gold was at its peak.
Yeah,
so
I think
this is, any way you measure it, this is absolutely ridiculous.
And I think I was listening to Peter Schiff on Pomp's podcast, actually, and I think I see a trajectory, and it's not that far away. What are we, $3 trillion now for the size of the total market cap of crypto, where we're going to see that flip gold. I think double is where it's got to get to from where it is today, and on the growth trajectories that you've talked about, that is months, maybe few years away before it flips the size of gold as a market cap, which is frankly astounding considering the length of time we've been using gold as a medium of exchange and store of wealth.
Yeah, so my ability to predict is rather poor.
We don't do that here.
Predictions are difficult, especially about the future. What I found fascinating as I went through the numbers, the market, the crash we see earlier one in 2015, the crash we see in 2019, they honestly don't even register on the graph. If you look at the recent growth, if you look at the graph, it'll look small. It'll look small because you're comparing it to these peaks of 900% growth compared to GDP as a percent of GDP in 2017 and the like. We're still seeing, frankly, absurd growth rates. Now, I want to be clear for the listeners, that can't continue. And this just simply comes down to a law of large numbers. Even if you go from your 7, let's assume that the markets go crazy. If you go from your 7% of GDP to 14%, we double as a percent of GDP in the next 12 months. That's going to register as 100% year-over-year growth. So we're rapidly, Stephen, getting into a world where it's big enough that those growth rates simply have to fall.
Yeah, law of large numbers. Well, we're 36 minutes in, Jared. I think we've had a fantastic discussion. I think it was good to the analysis here. Stay away from price. Look at it as a percentage of GDP was really fascinating for me. I highly recommend our listeners go and check out the newsletter. We'll put that in the show notes so that you can go see. You've been listening to the Fat Tailed Thoughts podcast, joined as always by my co-host, Jared Klee. If you like what you hear, please click and subscribe on your favorite podcast channel. Give us a 5-star rating. If you've got issues with the podcast, Jared's Twitter ID is Kleebeard. I'm not going to tell you mine unless you've got positive things to say. But please get engaged. Please share this with your friends and colleagues. We're looking to grow this platform. You've been listening to the Fat Tailed Thoughts podcast. We'll speak to you again soon. Thanks very much for listening.